Do you know that Bosch company has a PE ratio of 500.28 while the industry PE ratio is just 42.84? Does buying stocks at such high PE valuation make sense? Namaste everyone, welcome to our YouTube channel The Money Master. I am Pooja Sharma. In this video, we are going to talk about whether you should invest in companies with high PE or not. The valuations which may seem too expensive from the outside. In the last two videos, we have talked about what is a PE ratio and why a company with a low PE ratio isn't necessarily a good company to invest in. I highly recommend that you watch those videos if you haven't already. If you are going to watch those videos plus this video, then you can understand the concept of PE ratio really well. So the next time you'll do the PE analysis, these videos will come in handy and you will be able to conduct a comprehensive analysis of any stock. So go ahead and check out those videos. You can see them in the I button or in the description as well. Now, the main question comes, is a high price to earnings ratio good? Let's find out. A higher PE ratio means that the buyers now have to pay higher value for each rupee the company has earned over the last year. Now, this isn't a good thing or a bad thing, but a high PE implies higher expectations of what a company can earn in the future. The general rule says that don't invest in companies with higher PE ratios. But there are some really good companies with strong fundamentals and authentic promoter background which have higher PE ratio. Now, this higher PE ratio doesn't necessarily make them a bad investment. Now, there are a lot of factors which contribute to a higher PE ratio, and we are going to look at 4 such factors. Understanding these factors will help you better analyze the higher PE ratio and then finally make the decision whether you want to invest in the company or not. First is consistent growth in earnings. Investors like to invest in companies that are consistent in their performance and have a growth trajectory and earnings that are reliable and sustainable. Therefore, companies that have shown consistent growth in their earnings are preferred and investors are happy to pay more to get a share in their earnings. A good example of this would be Bajaj Finance. Bajaj Finance last month reported 30% year-on-year growth with net profit at 1161 crores for the quarter ended March 2021. The second is profitability. While growth is good, not all companies successfully convert that growth into profits. Hence, the market, which includes retail investors like us, rewards the companies that have shown higher efficiency in profits with a higher PE valuation. The ideal example for this is Reliance Industries. Earlier this year, Reliance Industries Limited reported that its net profit rose 108% from rupees 6348 crores to rupees 13,227 crores for the quarter ended March 2021. The third is return on equity. ROE measures the company's profitability in relation to its shareholders' equity. This is one of the most important ratios that all the investors consider before deciding to invest in a company. It tells us if the company can efficiently convert its shareholders' equity into profits. And usually the companies with higher ROEs and low debts are given higher PE ratios. Why low debt? We are going to cover that topic in the upcoming videos, but in this video, let's just see small calculation for ROE. We are going to calculate the ROE in the Excel sheet. Let's move to the Excel. Let's first look at the formula. So the formula for return on equity is net income divided by shareholders' equity. For the purpose of this video, we are going to take example of Page Industries. So we will need these two figures, that is one, net income, and second, shareholders' equity. Let's find out. So we looked on the internet and found on Money Control that net profit is 343.22 CR for Page Industries. Likewise, the shareholders' funds is 819.88 CR for Page Industries. Let's move back to the Excel. So now we have already punched in the figures, the net profit and the shareholders' funds, which is 343.22 CR and 819.88 CR. So the resultant return on equity will be 41.86%. As you can see, formula, we have divided net profit by the shareholders' equity. That's it. It was that simple. If you want us to make more videos on return on equity, let me know in the comments. The fourth and the last factor is the external macroeconomic conditions. Macroeconomic conditions impact the entire market. News, policy decisions, external macroeconomic situations, all these can cause the stock price to rise, resulting in a sudden boost to the PE ratio. A recent example of this is Coal India. Increasing demand in other sectors like steel is driving the electricity demand, and because a bulk of Coal India's output goes to power plants for power generation, its stock price has seen a sudden rise from the past 2 weeks. So what is the conclusion of all this? So the answer to investing in a company with high PE ratio lies less in the current market sentiments and more in the earning capacity of that stock or company. So that's all for this video. In the next video, we are going to talk about why industry's PE ratio is not relevant as it seems to be. Hope you enjoyed the video. If you did, give it a thumbs up and subscribe to the channel if you haven't already. And if you feel that we are able to add some values to your lives and contribute to your knowledge in the field of finance and stock market, then share this video with at least 2 of your closest friends. This will help us in expanding this Money Master family, and we will continue to bring more such research, educative content for you all. Till then, namaste, bye bye, and take care.